Welcome to our deep dive into The Art of Execution by Freeman-Shor.
Oh, yeah, I've heard of that one.
Have you read it?
I have,
Okay,
yeah.
great. Well, this book isn't your typical investing guide.
Right.
It dives into how top investors actually manage their portfolios, like
Hmm.
after they've made their initial investments,
Right, right.
and how that contributes to their success.
Mm.
So,
The interesting thing is Freeman-Shor analyzed a portfolio of some of the world's best investors and discovered that a lot of their picks actually lost money.
yeah,
It really challenges that idea that success comes from, always picking the right stocks.
yeah,
So,
that's right. And what the book argues is that the real skill lies in what you do after you've invested, like how you execute your plan, regardless of whether your initial picks were winners or losers.
right.
Yeah,
It's all about what you do after you make the investment.
exactly. And Freeman-Shor identifies a few distinct investor tribes based on their
More
behavior.
interesting.
So let's unpack some of these, starting with what to do when you're staring at a losing investment.
Okay.
Um,
So that's where the rabbits come in.
okay.
According to Freeman-Shor, these are often smart, even prestigious investors who consistently lose money.
Hmm.
And the culprit, human psychology.
So what kind of traps do these rabbits fall into?
Well, they tend to fall in love with their initial investment story
Yeah.
and refuse to change course even when the facts on the ground change.
Okay.
They get stuck anchoring to that original price they paid, ignoring new information.
Right.
It's almost like they're seeking out more and more information to avoid actually taking responsibility, but that doesn't really help.
Hmm.
They might even start following the crowd, looking for that safety in numbers,
Oh,
even
yeah.
when everyone's headed in the wrong direction.
Yeah.
Ultimately, it seems their ego gets in the way of admitting they were wrong.
I was just thinking about how we sometimes approach things in our own lives. Like, do we ever get stuck in a loop of seeking more and more information to justify our decisions?
Yeah.
Or find it hard to admit we were wrong? It seems this isn't just about investing. It's about how we all deal with our mistakes and adapt to change.
I think you've hit the nail on the head there, and this is where the danger of inaction really becomes clear.
Yeah.
The rabbits often get stuck in that analysis paralysis,
Mm.
hoping that things will somehow magically turn around.
Right.
Freeman-Shor actually found that only 3% of losing investments actually ended up making money due to the investors' actions after they made the initial purchase.
Wow. Only 3%.
Only 3%.
So what's the antidote to this rabbit mentality?
Well, I think the biggest takeaway is the importance of planning.
Okay.
Before you invest, have a clear plan for what you'll do if the stock drops,
Mhm.
whether it's 20%, 50%, or whatever your threshold is.
Right.
When you're going to cut your losses.
Right.
The rabbits didn't have that plan, and it definitely cost them.
That makes a lot of sense. So are you saying we should be more like the assassins,
Mhm.
the ones who cut their losses quickly and decisively?
The assassins definitely have a different approach. Yeah.
They're all about minimizing losses to maximize profits, acting almost like cold-hearted hitmen when it comes to preserving their capital.
Okay.
And they operate by two key rules.
Right.
The first rule is to kill all losers at 20 to 33%.
Okay.
This is based on the idea that the further a stock falls, the less likely it is to recover.
But isn't there a risk of selling too early and missing out on a potential rebound? I mean, sometimes stocks do bounce back, right?
That's a good question. And the assassins have thought about that. They look at the data.
Okay.
And Freeman-Shor found that only 11% of winning investments actually had returns over 50%. So if you set your stop loss above 33%, you might miss out on some potential winners, but you're also significantly reducing your risk of deeper losses.
So the assassins are playing the odds, accepting that they might miss out on some big wins, but minimizing their potential for catastrophic losses.
Exactly. And their second rule is to sell any stock that isn't showing any signs of recovery after 6 to 12 months.
This helps prevent them from getting stuck in those dead-end investments and frees up their capital for better opportunities. One of the key things that sets the assassins apart is their discipline.
Right.
They set these rules beforehand, which helps them take the emotion out of the equation
Yeah.
when those losses start to really sting.
That's right. Having those rules in place ahead of time can help you avoid making impulsive decisions driven by fear or regret.
Right.
So could you give us a real-world example of how this assassin approach actually plays out?
Sure. The book mentions a case involving Genmab, the Danish biotech company.
Okay.
One of the assassins invested in it, but then had to take a 30% loss when his stop loss was triggered.
Okay.
It might seem painful in the moment, but the stock actually went on to fall another 49%.
Wow.
So by being disciplined and cutting his losses early, he avoided a much, much deeper hole.
Okay, so cutting losses quickly can help prevent those big drops from turning into portfolio disasters. Do you have another example?
Absolutely. There's also the case of Dodds, a UK media company. One of the assassins bought in, but 10 months later, his 39% stop loss kicked in.
Oof.
Again, not a fun experience. But the stock then proceeded to plunge another 63%.
Wow, that's a massive drop.
Yeah.
So these examples really illustrate how sticking to a predetermined plan can protect you from those huge losses, even if it means accepting a smaller loss up front.
Right.
It seems like the key is to remove emotion from the equation and focus on managing risk effectively.
That's exactly right. But what if instead of cutting your losses, you actually increased your investment when a stock price falls?
That sounds pretty risky. You're talking about doubling down when things get rough?
Yes, exactly. And that brings us to the hunters.
The hunters, huh? They sound like they have nerves of steel. Tell me more about them.
The hunters are definitely a fascinating bunch. They're the ultimate contrarians, you see. They see falling prices as an opportunity to buy more of what they believe is a good investment.
So they buy when the price is going down.
They essentially double down when everyone else is panicking and heading for the exits.
So it's almost like they're bargain hunting, but in the stock market.
Exactly. And their core belief is that if the original reasons they invested in a company, what they call the investment thesis,
Yeah.
if that hasn't changed, then a lower price just makes that investment even more attractive.
It takes some guts to buy more of a stock when it's already going down. Most people would probably run in the opposite direction.
That's true. It's a counterintuitive approach, but that's what sets the hunters apart. They're comfortable with short-term losses because they're focused on that long-term potential. They see a price drop as a chance to lower their average cost and potentially increase their returns when the stock recovers. But here's the thing. They're not reckless about it. They have a disciplined approach.
So they don't just go all in as soon as the price dips.
No, definitely not. The hunters are strategic. They keep a portion of their cash on the sidelines specifically for those potential price drops. They have a clear plan for when they'll buy more often, setting predetermined price levels at which they'll add to their position. It's not about chasing every dip. It's about buying more when they see real value.
It sounds like it takes a lot of patience and conviction to be a hunter.
It absolutely does. And what's interesting is that many of these hunters actually experience significant losses early in their careers.
Oh, really?
And it seems like those experiences really shaped their approach. They learn some tough lessons about market psychology and how fear can drive people to make irrational decisions. It's those scars that give them the confidence to go against the crowd and stick to their convictions.
That makes sense. Those early losses probably help them develop their patience and that long-term perspective. Do you have any examples of how this hunter approach has played out in the real world?
Of course. One example from the book involves Aker Solutions, a Norwegian oil services company. One of the hunters invested, but then the stock took a serious plunge. Now, most people would panic and sell at this point, but he didn't. He saw it as an opportunity and bought significantly more shares, bringing down his average cost. And when the stock eventually recovered, he ended up making a substantial profit.
So he turned a potential disaster into a winning trade simply by buying more when the price dropped.
That's incredible.
It really shows the power of patience and conviction. There's also the example of Technip, a French engineering firm.
Okay.
A hunter bought in, and again, the stock dropped. He didn't flinch. He doubled down, lowering his average cost. What's fascinating about this case is that he actually ended up selling for a gain, even though the final price was lower than his initial purchase.
That's amazing. He made money even though the stock didn't fully recover?
Exactly. It's because he strategically bought more when the price was low. So even though he sold at a price lower than his initial purchase, his average cost was much lower thanks to his additional purchases. It's a great example of how the hunter approach can help you navigate even those volatile situations. Yeah, it's clear that this approach can be very effective. But you mentioned earlier that it's not for everyone. What kind of personality traits and mindset do you think are needed to be a successful hunter?
Well, you definitely need a high tolerance for volatility.
Okay.
You can't panic and sell at the first sign of trouble. You have to be comfortable seeing your portfolio drop in the short term.
I guess you also need to have a good understanding of the businesses you're investing in. You wouldn't want to just blindly buy more of any stock just because it's going down.
Absolutely. You need to have conviction in your investment thesis. You need to believe that the business is fundamentally sound and that the market is undervaluing it for some reason.
It sounds like it takes a lot of research and due diligence to be a successful hunter. You can't just go chasing every falling stock.
You're absolutely right. It's a strategy that requires careful analysis and a strong stomach for risk. Now, the interesting thing is that this hunter approach aligns really well with a mathematical concept called the Kelly criterion.
The Kelly criterion. That sounds intriguing. Tell me more about it.
Well, the Kelly criterion is a formula that tells you how much to bet on something to maximize your winnings over time, taking into account your edge and the probability of success. So think of it like this. Imagine you're betting on a coin flip, but you know that the coin is slightly biased in your favor.
Okay.
It's going to land on heads, say, 60% of the time. The Kelly criterion would tell you how much of your money to bet on each flip to maximize your winnings over the long run.
So how does that apply to the hunters?
Well, in the hunter's case, their edge is their conviction in their investment thesis. And the probability of success increases as the price drops, assuming their thesis remains valid. So as the price falls further and their conviction remains strong, the Kelly criterion would suggest that they should increase their investment, just like increasing the bet size on that biased coin flip.
So the further the price drops, the more they should buy, assuming their thesis is still sound.
That's the idea. They're essentially exploiting the market's irrationality by buying more when the odds in their view are becoming more favorable.
It's a fascinating approach, but definitely not for the faint of heart. So we've looked at two very different approaches to handling losing investments. The assassins who cut their losses quickly and decisively, and the hunters who double down on their convictions. Which approach is better?
Well, there's no simple answer to that. Both approaches can be successful, and it really depends on the individual investor's personality, risk tolerance, and investment goals. Some investors might prefer the relative certainty of cutting their losses and moving on, while others might be drawn to the potential for outsized returns that come with a hunter strategy.
It's almost like choosing your own adventure when it comes to investing. You have to decide what path aligns best with your own style and comfort level. But what about when you're on the winning side? How do these investor tribes handle their winning investments?
That's a great question. And it turns out that even success can have its own set of pitfalls. There's actually a whole tribe dedicated to snatching profits too early, the raiders.
Raiders, huh? It sounds like they're leaving a lot of potential treasure on the table.
That's a great way to put it. They're like those treasure hunters,
Mm-hmm.
who grab a handful of gold and sprint back to the surface, missing out on the real riches hidden deeper within the temple.
So what drives them to sell so early?
Well, it seems like their main motivation is fear. They're terrified of losing their hard-earned gains, so they'd rather lock in a small profit now than risk losing it all by holding out for something bigger.
I guess it's that classic fear and greed dynamic at play. Greed pushes you to buy, and then fear pushes you to sell.
Exactly. And Freeman-Shor's research actually found that a whopping 66% of winning investments were sold for a profit of less than 20%.
Wow, that's more than half. It really shows how common this raider behavior is.
It does. And it's a shame because they're essentially cutting themselves off at the knees, preventing their winners from reaching their full potential. It's like they're picking up pennies in front of a steamroller, as the saying goes. It might work for a while, but eventually it's going to catch up with you.
Do you have any real-world examples of raiders getting well rated?
Oh, absolutely. One of the examples from the book is Chicago Bridge and Iron, an energy infrastructure company.
Okay.
One raider bought in and quickly sold a month later for a 15% gain. Not bad, right?
Sounds like a decent profit.
Yeah, but the stock then went on to surge another 147%.
Oh, wow.
He left over a decade's worth of potential returns on the table simply because he couldn't resist that quick profit.
That's incredible.
Yeah.
He could have multiplied his investment several times over if he just held on a bit longer.
Yeah.
Do you have any other examples?
There's also British American Tobacco.
Okay.
A raider bought in, and within just 2 months, he was out with a 10% gain.
No.
He probably patted himself on the back thinking he'd made a smart move.
But I'm guessing the story didn't end there.
Not at all. The stock ended up climbing to a 277% return.
Ouch.
That quick 10% gain looks pretty insignificant compared to the massive returns he missed out on.
These examples are pretty eye-opening.
Wait.
What do you think are some of the psychological factors that drive this raider behavior?
Well, Freeman-Shor delves into that in the book. Part of it seems to be that dopamine rush you get from taking profits. Our brains are wired to seek out those rewards, and a quick profit triggers those feel-good chemicals. It's almost like an addiction.
That makes sense. And I guess there's also the fear of losing those gains. It's that classic loss aversion bias where the pain of a loss outweighs the pleasure of an equivalent gain.
Exactly. And then there's the anchoring bias where people tend to fixate on that original price they paid for something. So even if a stock has gone up significantly, they still see it through the lens of that initial price, and any profit feels like a win, even if it's a small one.
So it's almost like they're constantly comparing their current position to their starting point rather than looking at the bigger picture.
That's right. And I think overconfidence also plays a role. Raiders tend to believe they can easily find the next big winner, so they don't see the need to hold on to their current winners for too long. They'd rather cash out and move on to the next hot stock.
It seems like this mindset can be a real obstacle to long-term success in the market.
It definitely can be. It's important to remember that those big multi-bagger winners are rare, and riding them is crucial for achieving those outsized returns that we all dream of.
That's a good point. So if the raiders are focused on snatching quick profits, what about the investors who take the opposite approach? The ones who hold onto their winners for the long haul?
Well, that brings us to the most successful tribe in the book, the connoisseurs.
The connoisseurs. I like the sound of that. Tell me more.
These investors are the polar opposite of the raiders. They treat their winning investments like fine wine, letting them age and mature, savoring the experience over time.
So they have that long-term mindset focusing on the power of compounding over time.
Exactly. They believe that the best investments get better with age, and their patience is often rewarded handsomely. One of their key principles is that they have very high conviction in their best ideas. They might hold on to these investments for years, even decades, allowing the power of compounding to really work its magic.
That's incredible. It takes a lot of discipline and trust in your own judgment to hold on to an investment for that long, especially when the market is going through its inevitable ups and downs.
It absolutely does. And they might trim their winners along the way, taking some profits off the table, but they avoid selling out entirely. They understand that timing the market perfectly is nearly impossible, and they'd rather stay invested and capture as much of the upside as possible.
So they're not trying to time the market, they're trying to time their investments.
That's a great way to put it. And one thing that really sets the connoisseurs apart is their high boredom threshold. They're not constantly chasing the next hot stock or jumping in and out of the market. They're comfortable doing nothing if their investment thesis remains intact. They understand that the best investments often take time to play out.
Sounds like a very Zen approach to investing.
Mm-hmm.
Patience, discipline, and a long-term perspective. Do you have any examples of how this connoisseur approach has actually worked in practice?
Of course. One example from the book is Adobe Systems. One connoisseur held on to the stock for nearly 4 years, riding it to an impressive 240% return.
Wow.
He trimmed his position along the way to manage his risk and take some profits, but he never completely abandoned his winning position.
So he had the discipline to hold on and let his winner run, even when it probably felt tempting to sell and lock in those gains. Do you have any other examples?
There's also a fascinating example involving President Chain Stores, a Taiwanese food conglomerate.
Okay.
A connoisseur held this investment for 5 years, eventually earning a 173% return. He did some trimming along the way, but he never gave in to that raider urge to cash out early.
These examples really highlight the power of patience and conviction, letting your winners run, and allowing that compounding effect to work its magic.
And what's interesting is that this connoisseur approach has some serious academic backing.
Really?
Research from Harvard and the London School of Economics has shown that concentrated portfolios where you focus on a smaller number of high-conviction picks can actually outperform those more diversified portfolios that a lot of people recommend.
So it's not just about picking the right stocks. It's about having the conviction to bet big on your best ideas and then having the discipline to hold on to them even when it gets uncomfortable.
That's exactly right. But as with any investment approach, there are potential downsides.
Right.
One risk is becoming too attached to your winners.
Okay.
You might start ignoring warning signs that the story has changed, or you might become so confident in your initial assessment that you miss those crucial signals that it's time to sell.
That makes sense.
Yeah.
Even if you're a connoisseur, you can't just buy and forget. You need to constantly reevaluate your investments and make sure your thesis is still intact.
You're absolutely right. And even if your thesis is still valid, market conditions can change quickly. A stock that was a winner for years might suddenly face new competition, a change in consumer behavior, or a shift in the macroeconomic environment. Connoisseurs need to be aware of these risks and be prepared to adjust their approach if necessary.
So it's about finding that balance between conviction and flexibility, having the confidence to stick to your best ideas, but also the humility to recognize when it's time to change course.
Well said. It's a dynamic process, and it requires constant learning and adaptation.
This has been such a fascinating deep dive into the art of execution. We've covered so much ground, from the psychological traps that can lead to losses to the strategies that can help you maximize your gains.
Absolutely. It's a reminder that success in investing isn't just about finding those hidden gems. It's about having a plan, understanding your own biases, and developing those winning habits that can help you navigate the ups and downs of the market.
Well, the book really focuses on the actions of individual investors, but I can't help but wonder if these same principles could apply to investing in broader markets, like index funds or ETFs. What do you think?
That's a great question. It certainly makes you think about how you might apply the principles of cutting your losses, writing your winners, and managing your emotions to a more passive investing approach.
It's definitely something for our listeners to ponder as they continue their own investment journey. Thanks for joining me for this deep dive into the art of execution.
It was my pleasure. And until next time, remember to keep learning, keep exploring, and keep executing those winning investments.